Financial mistakes are expensive, but not in the obvious way. The truly expensive ones are invisible, habits and patterns that compound silently for years until the total cost shocks you. Not bad stock picks, not overspending. The mistakes costing Americans $300, even $500,000. Those are the decisions people don't even realize they were making. Today, we name all 10. 10 mistakes, 10 real dollar costs, no fluff, so you can recognize every single one and never make them again. Let's go. Think about your last big financial decision: a car purchase, a job offer, maybe credit card debt you've been ignoring. Hold that thought, because by the end, you'll see exactly what that decision is really costing you. This isn't about cutting coffee. We're giving you the actual dollar damage, real math. Because when you see the number, something clicks and you start making different choices. 10 mistakes, $10 costs, starting with the single most expensive mistake millions of Americans make every year. Mistake number 1. Mistake 1. Not starting your retirement account before 35. Delaying your 401k or Roth IRA from age 25 to 35 costs the average American between $300,000 and $500,000 in final retirement wealth. Not because you lost it, simply because you waited. This single delay is the most expensive decision most people will ever make. And it's invisible, because nothing hurts right now when you don't start. The fix: open a Roth IRA today. Fidelity, Vanguard, Schwab. All free to open online in 20 minutes. Even $50 a month makes a real difference. Start today. Not Monday, today. Mistake 2. Financing a brand new car smell, 0 miles. Nobody's eaten fast food in the back yet. Feels great, but here's what that feeling is actually costing you. On a $35,000 new car at 6%, and 2026 rates are actually 7 to 9%. You pay $8,000 to $12,000 in first year depreciation plus $6,000 to $10,000 in interest. That's $14,000 to $22,000 extra on one car. The smarter move: buy a 2 to 3 year old equivalent vehicle. Same reliability, 0 first year depreciation. And always check current loan rates before walking into any dealership. Never let them be your only option. Mistake 3. Paying high mutual fund fees instead of low-cost index funds. This is the most preventable wealth destruction in personal finance. And most people miss it because 1.2% sounds tiny. On $50,000 over 30 years, that fee difference costs $29,000. Scale to a $400,000 portfolio and fees drain $100,000 to $250,000. Switch to index funds, Vanguard FIOO or Fidelity FZROX, both under 0.1%. Mistake 4. Paying credit card interest. $5,000 at 22% APR. Minimum payments only. You repay over $11,000 and take 9 years. You borrowed $5,000. You paid back $11,000. That math is brutal. Eliminating credit card debt is always the highest return financial action available. Paying off 22% interest equals a guaranteed 22% return. No stock market gives you that reliably. Full stop. Mistake 5. Under-insuring. Specifically, no income protection insurance. Scenario: you're 35, you get seriously injured and can't work. No policy. You could lose your home, drain your savings, and never financially recover. The lifetime earnings loss from an uninsured disability at 35 can exceed $1.5 million. And income protection for a healthy adult under 40 in the US costs $40 to $120 monthly. Less than one dinner out. Quick note: insurance costs vary by age, health, occupation, and state. Those figures apply to healthy adults under 40 in the United States. Get a personalized quote from a licensed provider. Protect your income. It's your most valuable asset. Mistake 6. Early retirement withdrawal. In the US, pulling from your 401k before 59.5 triggers a 10% IRS penalty immediately, plus income tax on top. On a $20,000 withdrawal at 22%, you instantly lose $6,400. That's 32 cents on every dollar. But the real cost is deeper. that $20,000 withdrawn at 35 would have grown to approximately $100,000 by retirement at 65. Compound growth no longer works on that money for 30 years. Important. These 10% penalty rules apply specifically to US 401k accounts. UK, Australia, Canada, your rules are completely different. Check with your local tax authority before touching any retirement funds. The principle stands everywhere. Don't touch retirement money early. Mistake 7. Not comparing mortgage rates. Just 0.5% higher on a $350,000 loan over 30 years costs $34,400 extra in interest for skipping a 2-hour process. Highest hourly rate activity in personal finance. The fix. Get at least 3 mortgage quotes. Use Bankrate or Lending Tree. One extra quote frequently finds rates 1/4 to 3/4% lower. On a $350 loan, that's $17,000 to $50,000 saved. Do the math, do the work. Mistake 8, treating your home like a personal ATM. Build up equity, pull it out for renovations, vacations, new cars, via cash out refinance or home equity loans. And in 2026, those loans are running 7 to 9% interest. This pattern is expensive. Here's the nuance. Strategic renovations like kitchens and bathrooms can return 50 to 70 cents per dollar in added home value. That can work. The danger is using home equity for pure lifestyle spending. Vacations, luxury goods, depreciating assets. Evaluate each situation. The long-term result, you reach retirement with a $400,000 house on paper but empty liquid savings. You cannot pay for groceries with a floor plan. The home is valuable. Just don't let it be your only valuable. Mistake 9. Not negotiating your starting salary. Failing to negotiate just $5,000 more with 3% annual raises compounding over 30 years cost the average American worker over $175,000 in lifetime earnings. Why? Because every raise, bonus, and future salary is anchored to that original base. $5,000 extra at the start compounds into $175,000 over a career. Raises, bonuses, pension calculations, everything builds from that original number. The script is simple. Thank them for the offer. Say you were hoping to reach a specific number. That's it. Worst case, they say no. Best case, you just earned yourself a $175,000 lifetime raise. Ask every single time. Mistake 10, waiting for perfect conditions to invest. The playlist of excuses. I'll start when I have more money. After I pay off this debt. When the market dips. After the election. I've heard them all. Here's the truth. The perfect time never comes. Vanguard Investment Strategy Group found that investing immediately outperforms waiting for a market dip in 68% of historical scenarios. Note, Vanguard is not endorsing this video. This is educational citation only. Past performance doesn't guarantee future results, but 68%, that's 2/3 of all cases. The cost of waiting is real and measurable. Every month you delay, you lose that month of compound growth forever. The perfect time to invest is when you have anything to invest, even $25. Start now. That's all 10. And here's your rapid recap before the most important question. Mistake 1, retirement delay up to $500,000. Mistake 2, new car up to $22,000. Mistake 3, fund fees up to $250,000. Mistake 4, credit card interest up to $15,000. Mistake 5, under-insuring $1.5 million. Mistake 6, early withdrawal up to $100,000. Mistake 7, mortgage rates $34,000. Mistake 8, home as ATM, asset rich, cash poor. Think about how much is quietly leaving. Mistake 9, salary negotiation $175,000. Mistake 10, waiting to invest, immeasurable, because time cannot be bought back. Make half these mistakes over a lifetime and you've lost over $1 million in wealth. Not from bad luck, from fixable patterns. Here's my question for you. How many of these 10 are you currently making? Be honest, most people have at least 2 or 3 working against them right now. The goal here is not shame, it's clarity. Drop your number in the comments right now. and if you want specific guidance on any of them, tell me which one. Write mistake 2 or mistake 7. I read every comment. The most requested ones become dedicated deep dive videos. If this video was valuable, share it with one person, one friend, one family member, one coworker. You know exactly who needs to hear this right now. Send it to them. That one share could genuinely change their financial life. If you're not subscribed and this gave you real value, hit subscribe. This channel is built on one thing: real financial education most Americans never got in school. No fluff, no get rich quick, just clarity. You cannot undo financial mistakes already made, but you can stop making them today. And in personal finance, today always has enormous long-term impact. Every good decision from this moment compounds in your favor. Choose differently, starting now. That is the entire lesson. See you in the next one. This video is for educational purposes only, not financial, tax, investment, or legal advice. All figures are based on publicly available data and historical averages. Individual results will vary. Always consult a qualified financial advisor before making major money decisions. Thank you for watching this all the way through. If even one thing changes for you because of this, it was worth it. Like it, save it, share it, choose differently, starting now.